Welcome back. Here with Money, and here is our tip of the week. 2015 has often been called the year of the fixed income. But a key risk associated with debt instruments is the interest rate risk. This refers to a change in the price of bonds due to the change in the prevailing interest rates. As interest rates fall, bond prices rise and vice versa. Something we saw just earlier this week when RBI Governor Raghuram Rajan cut the repo rate by 50 basis points. So what should be the investor strategy in this scenario? Whether you want to invest or borrow, how can you benefit from a scenario of falling interest rates? The first thing to remember is that a rate cut by the RBI does not automatically mean a cut in the interest rate on your loan. This call is taken by individual banks. Though following Rajan's repeated calls for higher transmission, the expectation is that banks will pass on the benefits this time around. If you're borrowing, the effect of this rate cut could be almost immediate. So be sure to check the new rate applicable on your floating rate loan. If you're looking to take a loan now, experts advise that for those who are looking at a borrowing period of 20 years should remember that lower rates may not prevail through the entire term of the loan. 2 decades is a long time with many up and down cycles of interest rates. A lower rate now may come down still further. As well, it could be much higher too. On the other hand, if you're stuck with a fixed rate loan, your options may now include refinancing of the loan. But here too, experts sound a note of caution. Refinancing does not come cheap. Shifting your loan to another bank includes costs like processing fee, admin fee and so on. This requires that the individual do a cost analysis to check whether the likely benefits outweigh the costs. For those looking to take advantage of the lower interest rate from their investment point of view, the recent oversubscription of the NTPC tax-free bonds is a case in point. The issue was oversubscribed 11 times on the opening day itself. Overall interest rates were expected to head lower, and therefore other tax-free bonds set to come up later were likely to offer lower rates, since they're linked to the prevailing rates on government securities, and hence the rush for NTPC's issuance to lock in the higher rate offered. Therefore, while you may be benefiting from lower rates on your borrowing, you may also now be getting lower rates on your savings or debt instruments. Long-term debt funds with maturities of 5 to 7 years and beyond are likely to see the maximum benefit in a scenario of falling rates, as would duration funds. Conversely, short-term or liquid funds offer lower returns when rates fall. Do remember that the higher the maturity profile of a fund's portfolio, the more prone it is to interest rate risk and therefore higher the return offered. So in a falling interest rate scenario, opt for funds with higher maturities and the reverse in a rising interest rate scenario. Remember viewers, keep writing to us at money at network18online.com. You can also find us on Twitter, write to CNBC TV 18 News, and you can use the hashtag money. And remember that you can also log on to YouTube to catch this as well as all of our previous episodes. Thanks for watching. We'll see you again next week.